Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. Just a quick reminder that I have a new report. The download link is in the show notes, so you can have a look at that now. It summarizes really our investment approach towards investing in both property and shares. And I think hopefully brings together, all our thoughts around what is the best methodology, approach, and implementation. And my goal is to produce multiple versions of this document, by the way. So I want to keep it like a living document and I will add to it. So I'll let you know when I've updated and added more content and so forth. But it might be useful if you know of anyone that would benefit from having a good overview of that approach that sort of summarizes what I talk about on the podcast a lot, please share the download link or, send them the report or whatever you might want to do. That'd be great. Okay, so let's get into today's episode then. Today I want to talk about internal rate of return, which is a mathematical calculation of the performance of an investment. And I don't want to get too technical around it, even though it's a relatively simple maths equation. I don't want to get too technical about it, but I was having a discussion with someone that runs an investment business, and he made the observation, or shared the observation, that he thinks most investors don't understand the internal rate of return. And it's actually a really important metric to understand, particularly with respect to property investing, right? Because we tend to have an outlay in terms of holding costs, and we hope then we're going to get a return in terms of capital return. And the interaction between those two components delivers our total return on the investment on an after-tax basis, and that's what we want to maximize, right? So I talk a lot in this podcast about, property is really a growth asset, that its income profile from a residential property will never make you independently wealthy by itself, and that's because, property tends to attract a lot of expenses as well, and taxes like land tax, that eats away at the passive income. And even when I look at portfolios that clients have held for more than 30 years, they're still not producing a lot of income relative to the value. So it's all about the compounding capital growth. Okay, we know that that's fine, but how the income profile and capital growth profile interact makes a big difference to our investment return. So it's not like we should be blind to how the property performs on a cash flow basis, and that's what I really want to talk about. So typically when people go and invest in property, they tend to borrow, almost always, the entire cost of the purchase, including stamp duties. And they'll use equity in existing property, or, it depends on how they structure it. Sometimes if it's a first home, they might put in 10% cash. But I'm just generally talking about people that already have a home and go and invest in property. They'll tend to borrow the full cost. So they haven't actually put any of their cash flow into that investment. But of course, as we know, the investment's going to cost money each year because the rental income isn't enough to pay for all expenses, including interest on the mortgage that we used. So there's a holding cost. And that's really our investment, our cash contribution towards that investment. So for example, if a property costs me $30,000 a year to hold on an after-tax basis, and I hold that for 20 years, I've put in 20 times 30,000, $600,000 into that asset. That's my contribution. That's my investment. Okay, so that's only one side of the coin. The other side of the coin is the return. Okay, so what is the return? Well, for some properties, they'll start producing a positive cash flow, albeit probably not that material, but we can certainly include that part as a investment return. But really, in reality, the most substantial investment return we'll receive is if and when we sell the asset, and after we repay the loan, and after we pay for selling costs and capital gains tax, the amount of money that ends up in our bank account, that is our return. So the holding cost is our investment. The capital growth essentially is our return, or net sale proceeds, if you like. So the internal rate of return, what it seeks to do is measure what percentage return did I receive from my investment. So if I go back to the original question, or the original example, I should say, of property costing me $30,000 on average over a 20-year period, that's $600,000. If I then get $3 million in terms of cash proceeds, what percentage return did I receive? Because I didn't invest the 600 all in one hit. I did it over 20-year periods. I've got the time value of money, all those sorts of things, but I need to know what my percentage return is. And you might ask, well, that's theoretical, Stuart. Does it have any application? Yeah, of course it does, because instead of putting that 30 grand towards the property and its holding costs, I could have put it into super. I could have put it into the share market. I could have put it into other investments. So it's really important that I'm benchmarking to know, is that the best use of money? Because if my internal rate of return is, say, only 3%, that's a silly investment. I could do much better even if I just put the money into super. Whereas if my internal rate of return is 20%, well, I know property investing has worked out well for me, and I've got a clear indication that it was the best use of my cash flow over the last 20 years. Okay, so I've got a table in the blog on the website that calculates the internal rate of return based on a few different scenarios. And the scenarios that I've chosen is a 9% total return. So that 9% includes both the gross rental yield plus the capital growth rate on the property. So at the extremes, I've got, a low income, high growth property. So low rental yield of 1.5% and capital growth rate of 7.5%. It gives me a total of 9%. And at the other extreme, I've got a high income, low growth property, 6% gross rental yield plus 3% growth, 9% total return. It's really important that we make sure the total return is consistent between all these scenarios in order to measure the interaction between rental yield, gross rental yield, and capital growth. And the other important observation that I should add here as well is that it's very unlikely that you're going to find a property that is going to be both high income and high growth over a multi-decade period. Remember, what we're trying to do here is invest for the long term. And we've got to think about what are the average returns we're going to receive over that 20 or 30-year period, that very long period of time. Now, if we think we're going to invest in property, I think some people believe this, by the way, or get led to believe it. If we're going to invest in property and it's yielding 6% in terms of gross rental yield, and by the way, the last 3 or 4 years, the growth in the area has also been fantastic. A lot of people probably think in that scenario, well, that's what I should expect over the long period of time. But for me to get 6% income and 6% growth, a 12% total return, I think you'd be really careful about making that long-term assumption. Now, some properties might yield a total return of 12% or more around Australia. I'm sure some of the mansions in Point Piper in Sydney have done incredibly well, but, they're extremely scarce, extremely unique and very expensive types of property. But if we're looking at a regional location, for instance, that's a lot different than Point Piper. I just don't think it makes sense when you're doing an analysis and when you're drafting an investment strategy to assume a return of more than, say, 9%. And I would really say the range should be 7 to 10%. I picked 9%. I think that's realistic. And we could argue over whether that's too high or too low, but I think, it's thereabouts. So I think that's an important aspect to understand, because when we're making an investment, we've got to think about, I'm going to buy this property. And there are some things you can do to change the rental yield. Of course, you can improve the asset, particularly if it's got alternative productive uses, which I've spoken about over the last couple of weeks and which I'll talk about more. You can change a little bit, but the capital growth rate is pretty much locked in because it's all about the land location, its scarcity, and its size and quality and all those sorts of things. And so the capital growth rate is kind of locked in when you first buy it. So you can't really do much to change it. So I think it's really important to make sure that we're thinking about what will the average returns be over the next 30 years and not get too influenced by the most recent shorter term returns, whether they're positive or negative, by the way, because you can find markets that have been unloved for, Melbourne's one of them, for, the last 7.5 years in particular. And, that's not to suggest that the next 30 years are going to be just as poor as the last 7.5, of course. Okay, so I encourage you to have a look at the table because it's really hard to go through a table of numbers on a podcast, of course. But let's compare the low income, high growth property. So that's 1.5% yield plus 7.5% growth to the high income, low growth property, which is 6% income, 3% growth. So again, total return of 9%. Let's look at the internal rate of returns. The internal rate of return for the low income, high growth property is 10.5%. And that's assuming we hold the property for 30 years. We sell the asset, we repay the loan, we pay for capital gains tax, all selling costs. I've included all the factors in land tax, all those sorts of things in that number. So that's the total return. So if I go back to my previous example, if property costs me $30,000 a year and I hold it for 20 years, well, in this scenario, I've done the calculation over 30 because that's, I think, more realistic for a long-term asset. But essentially what I've returned is 10.5% on an after-tax basis. And that's a pretty good return, right? You're not going to get 10.5% in any super on after-tax basis, probably. So certainly investing in property is better. But when you compare that to the high income, low growth property, the internal rate of return is slightly higher at 11%. So an extra 0.5%. If you look at trying to find a balance, so if you look at sort of 3.5% income, 5.5% growth, the internal rate of return is 9.6%. And that's really, if you end up trying to balance the income and growth on a property, you end up with the lowest internal rate of return, by the way. And I think that's an important takeaway. So I guess what you'd say to me then is, Stuart, okay, that's good. So, the high income, low growth property, 11% total return, that's the one to go for. Well, there's a couple of observations there. The reason the high income, low growth property has a higher internal rate of return is because the holding costs are a lot lower because the income yield is higher, of course. In fact, the projections suggest that the property turns positive cash flow after just 13 years. So my calculations are over a 30-year period. And so the first 13 are negative and the remaining 17 are positive. And obviously that positive return adds to the internal rate of return. So I've invested less money in this asset. Also, because the starting yield is quite high, 6%, I've in all scenarios, grown rental income by 4.3% per annum. And that's just the long-term median house rental growth rate over the last 40 years. And what that means is because the rent is growing faster than the capital value of the asset, the gross rental yield actually increases over time. So that's because the rent's growing at 4.3%, but the asset value is only growing at 3%. So actually in 30 years' time, the gross rental yield increases to 8.4%. And I find that projection quite unlikely, right? I don't think rental yields are going to increase in that situation. I can't imagine what property attributes would make that a realistic outcome. So it's important to look at these projections. Look, the biggest difference here is whilst the internal rate of return might be attractive, being the highest internal rate of return, we've got to look at what are the net sale proceeds once we sell that property in 30 years' time. And the high income, low growth property gives us about $500,000, $520,000 in today's dollars in the bank after all taxes, repaying the loan, all expenses, etc. When you look at the high growth, low income property, the cash in the bank is $2.8 million. So whilst the internal rate of return for the low income, high growth property is 0.5% lower than the high income, low growth property, sounds like a bit of a Dr. Seuss book, this. Even though it's 0.5% higher, we've got a substantially different amount of capital at the end of the day. In fact, you'd have to invest in 5.5 high income, low growth properties to achieve the same dollar value return in terms of the amount in your bank account compared to owning just one low income, high growth property, which is pretty significant, right? But then if you look at the cash flow cost in terms of after tax holding costs to hold 5.5 high income, low growth properties, ironically, it costs you more, $85,000 a year after tax, compared to holding just one low income, high growth property, which is $34,000. So the key things to look at with this internal rate of return is not only what is the internal rate of return, but how much money in today's dollars do I end up with after holding a property for 10, 20, 30 years? Because $2.8 million, based on my numbers, is more than enough for people to build a perpetual portfolio and have a very enjoyable retirement, spending $120,000 a year, and they'll never run out of money mathematically. So that one asset alone, if you hold it for 30 years, is enough to help people fund retirement. Whereas the one high income, low growth property won't get anywhere near it. I mean, it's $500,000. It's not a small amount of money, but it's not actually going to get you there. So what can we learn then from the internal rate of return, and how do we apply this also to existing investments and assets? To maximize the internal rate of return, we really need to take a two-step approach. So when we first purchase an investment property, we're primarily worried about maximizing capital growth. In fact, that should be my only concern because, as I said, the capital growth prospects of a property are kind of locked in when you first buy the property because it's really about its location, the land size, the quality of the land, those sorts of things. So, and I've spoken about this before, when we go and select a property, I'm not worried about income at all. It's really all about the land. And I'd like to spend most of my budget on the underlying land, not on the improvements that sit on that land, because I can always change the improvements down the track. The land is what's going to drive the capital growth rate. And that's what I'm really focused on. So I'm going to be laser focused on capital growth when I'm selecting the asset. But after I have selected the asset, I'm going to flip the coin and I'm going to focus purely on improving the income profile of the property, because I've kind of locked in my capital growth rate. It's going to be what it's going to be. Now, I don't want to have to invest huge amounts of more money to adding to the improvements, because they're going to change the nature of the asset. If I spend $800,000 on land and then I go and spend $2 million on the dwelling of the property or dwellings, I've now got an asset that's got more improvements than there is land value. I'm not going to do that, of course, but within reason, I want to maximize the income profile of the property. I'm going to give you an example of how my wife and I did this for a property we own in Brisbane in a second, and I'll walk you through that. But it's about sort of making cosmetic improvements to the dwelling, reducing interest costs as much as possible, making sure I'm maximizing taxation benefits. It's all the components that go towards minimizing the holding costs, and interest rates is going to be the lion's share of it. They're going to be the big ones, but of course you want to maximize the stuff that you're in control of in terms of maximizing tax deductions, any depreciation that you might be able to get from the asset, all those sorts of things. So it's really buy the property purely for growth. Once you've sort of ticked that box, then start thinking about, how do I minimize the amount I need to contribute towards holding this property? Because I know if I do that, it frees up other cash flow for other things. I can make super contributions, repay my home loan, invest in the share market, do other things. And as a result of limiting or minimizing the amount of money I'm investing in this property, which is my cash contribution, I'm actually increasing the internal rate of return as a result. So I think I've spoken about this asset previously. My wife and I bought a property in mid-2021 in Brisbane in Indooroopilly. We bought it for $1.45 million, pretty much entirely land value. It had a dwelling on it at the time, really in very basic condition, and the tenant had been in that property for a very long period of time. And because there wasn't much to the property, they were only paying $400 a week in terms of rental income. So the yield was like 1.4%. It was tiny. It was a very small yield, but we knew that because we were paying mostly for land value. Last year, the tenants moved out, so we took the opportunity to complete some cosmetic renovations. That cost us around $120,000. Of course, it's been well documented, how much it costs to renovate a property. So we did a lot to the property, but anyway, it is what it is, 120 grand. And the rental income is now $675 a week, which is okay. But again, it's still a pretty basic house with a pretty ordinary floor plan, to be honest. And one day it needs to be bulldozed and rebuilt 100%. That's the highest and best use of that land. And if we did it, because I always talk about alternate purposes and uses, if we did it, we would be able to create quite a bit of value as a result of that. Anyway, so I worked out, because obviously I'm a nerd, I worked out, only for this episode, by the way, I didn't do it at the time, but I worked out that as a result of completing these renovations, we will increase our internal rate of return, after-tax internal rate of return, from 10.6% to 11.5%. So nearly an extra percent return as a result of making those cosmetic renovations. And it's a perfect example of what I'm talking about here in terms of approach. Spend all your money on the land. In time, then, and hopefully as soon as possible, improve the cash flow profile of the property. And in fact, I worked out that if you can improve the income profile of the property by around 10%, so if you reduce your holding costs by 10% per annum on average over the holding period, you increase your internal rate of return by about 0.5%. So it does show that it's quite sensitive to holding costs, but as long as you don't do that at the cost of your capital growth rate. Right, because now, for example, the thing is with that Brisbane property, we have now invested another $120,000 of capital. Of course, we use borrowings to fund those renovations, but we've invested more capital. So you don't want to invest too much more capital because, as I said, you change the nature of the asset and then that's going to impact your internal rate of return as well. But it is quite sensitive. And I think it's a really important concept to understand. And maybe I should have shared this with you at the beginning, but the analogy would be that if I'm going to start a forestry business, I'm going to buy some land and plant some trees. And let's say I borrow to fund the purchase of the land and the purchase of the trees and the planting of the trees. And then for the next 20 years or whatever it might be, I'm going to have to water those trees. I'm going to have to pay the interest on the loan. I'm going to have to look after the trees. There's going to be cost. That's my contribution. And then in 20 years' time, I'm going to harvest those trees. That's my return. And we can think about that sort of forestry example in the same way that we can think about property investing, in that we want to make sure that we're not going to compromise on the capital growth rate, because that's really where most of my return is going to come. And the extreme example of 3 versus 7.5% growth means that in 30 years we've either got $500,000 or $2.8 million. So, that I've made that point in terms of prioritizing the capital growth rate. But once we've done that, we then need to think about yield. So if you've got an investment then that's actually costing you a lot of money and you don't think over the long run, and this is important, I should underline, over the long run, it's going to deliver a strong capital growth rate, then you've got an investment that's going to have a low internal rate of return, because the contribution for you is significant, but the return is going to be much lower. And that's how you can think about it when you're looking at other assets, because the opportunity cost is, instead of holding that asset, you could put that money into super, or you could put it in the share market. There's other alternative uses for that money that can deliver a decent return, or perhaps a better return, of course. So there you go, folks. That's the internal rate of return as a concept and a calculation. And that's why I think it's really important to understand it, because once you understand what's driving the internal rate of return, then it'll help you make some smarter decisions around property investing, and most importantly, avoid being lured into making less than optimal decisions, which I think, I hang around social media a little bit, only LinkedIn and Twitter, but I see a lot of posts about properties that I'm skeptical about that will provide good long-term returns. That is, will maximize the capital growth rate and have the attributes where you can possibly minimize as much as possible. You're never going to eliminate negative cash flow, but minimize negative cash flow. That's the way you've got to really think about it. And I see a lot on social media that's not going to, fit that mold. And just mathematically, you've just got to understand that it's going to deliver a lower after-tax return, and that's inferior as an investment option. Okay, so let's get into some listener questions today. My first question is from Stefan, and he's asked a question around hedging. So I'm not going to answer it because I answered a hedging question yesterday in yesterday's Q&A podcast. And just to summarize my answer, hedging doesn't make a big difference in the long run. If you're investing a lot of new capital, I think you think about at what point in terms of exchange rate you're entering the market in, and whether you want to hedge that. At the moment, actually, the Aussie dollar dropped overnight. So again, I think I'd be hedging at the moment, when the Aussie dollar is trading a lot less than 70 cents. But in the long run, hedging doesn't really make a big difference to investment returns. That's what the studies show. Okay, next question is David. He writes, you always mention using an evidence-based strategy, which is great. You also talk about the benefits of alternative indexing methodologies. Can you go through the evidence for alternative methodologies, for example, equal weight and others, with a comparison to the more readily available and known market cap methodology? Good question, David. The interesting thing is that really market cap suits a growth market, which has been, it's been a growth market for nearly 15 years, particularly in the US, which means that companies that are perceived as high growth companies are then trading at much loftier PE ratios. And so that particularly around the technology sector. And so in a growth market, traditional market cap indexing is going to do well because your allocation is directly linked to the share price of that company. And as the share price rises, then so does your allocation across your portfolio and your exposure to that company. And if that momentum continues, of course, then you're going to enjoy good returns, which has been the case, as I said, for 10 plus years, particularly in the US. And so if you conduct a comparison between alternative indexing strategies today, they're going to look inferior. So that much I acknowledge. But when you look at the attributes over a longer period of time, well, Dimensional has a pretty famous chart that covers 1927 to 2022 in the US market, and value has outperformed growth by 4.4%. Now, value has underperformed growth significantly over the last 10 years. So there's your long-term evidence for value versus, like a value index versus a traditional market cap index that has no regard to how a company is valued, what it's trading at on a PE basis or price to sales or whatever metric you want to use. So that's value. S&P 500 does a lot of research and publishes a lot of research around equal weight versus S&P 500. So you'll find that data as well. Again, equal weights outperformed over the very long period of time. But because the mega cap companies in the US have done so well and driven most of the index returns over the last 10 years, if you compared equal weight over the last 10 years, it's not going to perform better. So this information is readily available. Now, when I wrote the blog about alternative index strategy, and for anyone that wants to look that up or listen to that again, it's episode 313. And I did that in July, actually, this year. I purposely didn't include a comparison of returns because I didn't want to, and sometimes I'm reluctant to really talk about returns, even though I'm an evidence-based approach, because sometimes people are just dazzled by returns, and sometimes you can cherry pick. I can cherry pick and say, well, here's a period that demonstrates that this is a better methodology. So we do that internally, of course, for our own benefit when formulating strategies, but in this sort of forum, I'm kind of reluctant to talk about returns. You don't want to be a return chaser. I mean, returns chasing can be a terrible thing to do. There's a famous story about a fund that Peter Lynch managed. It was called Fidelity Magellan Fund, I think. Between 1977 and 1980, the fund earned an average return of 29%. It's huge, of course, and Peter Lynch has written a book. But when the returns were studied, the average investor's return was as low as 7 to 8% per annum. And the reason is that they were, too late to the party. They sort of missed original performance and returns. And so that's the thing, right, particularly with alternative indexing methodologies. What we're trying to do is reduce the portfolio's risk and expose it to higher than average returns. There will be a switch eventually at some point, history tells us, from growth to value. And if you're not in value at that particular time when that switch happens, which none of us know when it's going to happen, there's been a couple of false starts over the last period of time. If you're not in value at that time, you're going to probably miss out on most of the returns, as the same study on the Peter Lynch Fund demonstrates. So I like to publish as much information, but I also need to consider whether that information is going to have unintended negative consequences, and therefore I don't like to really focus too much on returns, mostly around the methodology. But that's a great question, David, and you're right. There will be evidence behind everything I say, and if there's not, if it's just an opinion, I tend to very much highlight it, that I've got no evidence, but sometimes I don't always publish it. Okay, next question is from NJ. NJ writes, I recently purchased an old Queenslander in south of Brisbane for around about $1 million. I'm considering 3 options. Option 1 is to demolish the existing house, build a new one and rent it out for 10 years. Option 2, renovate the current house for around about $30,000, rent it out for $550 a week for 9 years, and then build a new house in the 10th year to sell it. And then third, build a new house immediately and sell it within 15 months to make approximately $200,000. What do you think is the best course of action? Thanks for the question, NJ. I'm a bit disappointed you added the third option, which is very much a short-term investment option. And, if you're writing to me about a short-term investment option, hopefully you can predict what the answer will be. We invest in property for compounding capital growth. To develop a property and sell it within a short period of time is okay, but it's not investing, that's a business. Right? The business is then about turnover and profit, and that's a different approach. Well, I don't really talk about business. I do on the Holistic Accounting podcast, but not on this podcast. I like to talk about investing. And for me, investing is about earning a strong passive return. And it's kind of good to answer NJ's question because it relates a little bit to today's episode about the internal rate of return calculation. So I don't like the third option. Let's knock that one out because short-term profit doesn't drive long-term value. And what you really want to earn is long-term value. I guess NJ's situation is a little bit similar to myself and my wife's situation with respect to the Indooroopilly property that I just spoke about in today's episode as well. So I would be leaning towards the second option, which is renovate for $30,000, rent it out for $550 a week, and then in 9 years decide what you want to do. I wouldn't necessarily then bulldoze and develop at that time. I would just look at the situation at that time. I did think about, with Indooroopilly, should we bulldoze and build something? The problem would be that we would be changing the nature of the asset. Yeah, I get depreciation, which would be fantastic, but we're changing the nature of the asset. And we'd have to build for that area and the size of block of land we have, a pretty big family home. Also, there's another issue with that property is it is actually on 2 titles, and maybe one day the Brisbane City Council will allow us to build 2 dwellings on that property that currently only has 1 dwelling. So a few different considerations there, but I decided against that because I am changing the nature of the assets, and then I've got an asset that is really, or a large amount that I've contributed towards this investment that's depreciating. Whereas I think renovating for 30 grand gives you a nice balance because you've still got a high growth property, which is the key thing here, right? Hopefully you can hang on to it for a lot longer than 10 years because I've done those calculations before. If you hang on to 30 versus 10, you're foregoing about 80% of the returns in terms of capital growth. So, because the capital growth takes a long time to really compound significantly. So, NJ, hopefully you can hang on to it for longer. But without knowing all the details of your situation and the property and so forth, just based on what you've told me, that's what I'd be thinking about, and that's probably where I'd be leaning. Before I let you go, just a reminder of the report that you can download and share to anyone that you might think will benefit from it. And also, if you can share the podcast, that'd be great. And until next week, bye for now.